Let's move on to our Chapter 3 quiz review for our LLQK exam. So let's dive in. Number 1, what is it called that life insurance policy provides several ways for the payment of a death benefit? Options, right? Policy settlement options. Life insurance policy may provide several options for the payment of a death benefit. These are usually referred to as policy settlement options, and the same form that the beneficiary claimant is asked to complete in order to establish the right to the death benefit may also ask them which payment option they prefer to receive. So proceed on deposit, or they want direct deposit or pick up. So there are many policy settlement options. When does the insurer invoke the limitation period? So when the claim was not made in a timely manner or timely fashion according to applicable provincial legislation. When the claim was not made in a timely fashion according to applicable provincial legislation, the fourth motive would be that the claim was not made in a timely fashion according to the applicable legislation, provincial legislation. In this case, the insurer would invoke the limitation period or deny the claim. So, oh no, I don't know. What do you mean? Let's continue to dive in. Okay. When you say invoke, what does that mean? So, in an insurance context, the insurer invokes the limitation period, option A. So can we invoke? What does that mean? Call on, in prayer, or incite or appeal. So the insurer can appeal someone something as an authority for an action or in support of an argument. When does the insurer invoke the limitation period? Meaning like appeal to authority for action or support. So yeah, let's continue to the explanation. Understanding the limitation period definition. A limitation period is a strict legal deadline within which an insured person must start a lawsuit or file a formal claim. Statute barred consequence. If you miss this deadline, your claim is absolutely barred, meaning the insurer is no longer legally obligated to pay, and a court will likely dismiss any legal action. Variation by province and policy. Standard period in most provinces like Ontario and Alberta, the basic limitation period is 2 years from the date the loss was discovered. Contractual shortening. Many property and automobile policy use statutory condition to shorten this period to just 1 year from the date of the loss. Why option B, C, D are incorrect? A policy lapse due to non-payment of premium which cancels coverage but is not an invocation of a legal time limit for filing a claim. Fraud. While fraud can lead to claim being denied, the limitation period specifically refers to the timing of the legal action, not the validity of the claim's content. Public order. This releases the legality of the contract purpose, not the procedural deadline for filing. Identify the specific limitation period for your province. Explain the discoverability principle when the clock usually start kicking. Okay. So it sounds like you're digging into the legal technical side of insurance for sure. Since you are looking for provincial legislation and limitation period, you might find it useful to check the specific insurance act for your province, as the CLAC is filing a claim can vary depending on whether it's for life insurance, disability, or property damage. So, like Ontario. Mm. Sometimes when we are focusing some thoughts, we need discipline, not to be distracted. Go. In Ontario, the rules for when an insurer can invoke a limitation period block your claim because it's too late are primarily governed by Limitation Act 2002. In 2026, the key rules are 2-year basic rule. Generally, you have 2 years to start a legal processing from the day you discover the claim. And then this discoverability principle. Clock doesn't necessarily start on the day on the accident or death. It starts when you first knew or reasonably should have known that a loss occurred was caused by the insurer denial that a lawsuit is appropriate way to fix it. The 1-year contractual trap. Be careful. Some property or commercial insurance policy contains statutory condition that contractually shorten this period to 1 year from the date of the loss. Courts in Ontario have upheld this shorter window if the language in the policy is clear. The 15-year ultimate deadline, regardless of when you discover the claim, there is an absolute ultimate limit of 15 years from the date the act or omission actually happened. So important 2026 update for Ontario. Starting July 1, 2026, Ontario is moving to a la carte auto insurance model. Only medical and rehabilitation benefit will remain mandatory. All other coverage like income replacement, death benefit will be optional. Limitation impact. If you do not actively opt in to these coverages, there may be no claim to make, rendering the limitation period irrelevant for those specific benefits. Warning: internal appeals. Insurers often suggest an internal appeal if they deny your claim. Common in life and disability insurance. In Ontario, 2-year court clock continues to run during this internal appeal. If you spend 2 years appealing internally without filing a lawsuit, you may lose your right to sue entirely. So if you are dealing with a specific situation, I can help you find a personal, okay, never mind. So when does the insurer invoke the limitation period or appeal? When the claim was not made in a timely fashion according to the applicable provincial legislation. So the fourth motive would be that the claim was not made in a timely fashion according to applicable provincial legislation. In that case, an insurer would invoke the limitation period. Okay? So important, if you have insurances, please let your loved one knows that you have this. Where did you file your policies, or where did you get it, so that they know when to file a claim when something happens. Under which coverage can a policyholder name a beneficiary? Under which coverage can a policyholder name a beneficiary? Sickness is yourself, suicide. Accidental death and dismemberment coverage, a policyholder can name a beneficiary. Why not in others? Sickness, disability insurance. So need more explanation? Yes. A policyholder can name a beneficiary under accident, death, and dismemberment coverage. Why is this, or why AD&D is the correct choice? Death benefit component or AD&D policies include a principal sum that is paid out if the insured dies due to a covered accident. There's a principal sum. Because this is a lump sum death benefit, the policyholder must designate a beneficiary to receive the fund. Dismemberment component, if the insured is injured but services, losses of limbs, sight, etc., the capital sum is typically paid directly to the policyholder, not a beneficiary. Accident, death, and dismemberment. Why other options do not apply? Sickness and disability, these are living benefits. Okay, so payment like income replacement are made directly to the insured person to cover their expenses while they are unable to work. You do not name a beneficiary for your own disability check. Suicide, this is not a type of coverage. It is an exclusion or a cause of death. Most life-insured policies have a suicide clause that denies the death benefit if the insured takes their own life within the 2 years of the policy. So, yeah, disability, but what if death? But they didn't mention kasi. So that's why accident, death, and dismemberment is the answer. Okay? They assume that they just got sick. They just got disabled. They're still alive. So they are the one who will receive the benefits. What is needed to substantiate an accident, death, and dismemberment claim? Detailed medical evidence to substantiate. Detailed medical evidence from a physician may be necessary to substantiate a claim, aside from the death certificate. Okay? So anyway, I need further explanation also there. To substantiate an accident, death, and dismemberment claim, the most critical requirement is the detailed medical evidence. Why detailed medical evidence is essential? While a death certificate confirms that someone died, it does not prove how they died. So when for AD&D claim to be successful, the claimant must prove the loss was the direct result of an accident and not a natural cause, illness, or self-inflicted injury. So accident death, the insurer needs the coroner. Oh, that's why coroner's report or autopsy finding to confirm the cause of death as was external and accidental. Dismemberment for living claims. A loss of limbs like that, the insurer requires attending physician statement and specialist report to confirm the extent of the loss and that it meets the policy specific definition if dismemberment. Coroner or autopsy findings. Why the others are secondary? Proof of age. Why the others are secondary? Proof of age, gender. These are verified during the initial underwriting process to set premiums. They did not substantiate the specific events of the accident. These are just secondary proof. Death certificate is required for all life insurance claim, but on its own, it is insufficient for accident, death, and dismemberment because it lacks the granular details needed to rule out medical exclusion. If you're preparing for exam or filing a claim, list the specific documents required in Canadian insurance, explain violent external, yes, help understand how to contest a denial claim. Yes, please. You have. To help you navigate the claim process or prepare for your exam, here are the breakdown of the violent, external, and accidental legal tests and the documentation needed in Ontario. So legal tests in Ontario for AD&D claim to be paid, the event must typically meet these three criteria. Violent this doesn't necessarily mean crime. In insurance law, it means a physical force was applied, impact of the car crash, like violent. External, the cause must come from outside the body, like a heart attack that causes falls is usually considered internal and may be denied as accidental. It should be external. Accidental, the result must be unintended or unexpected. So accidental to be considered as accidental. Next, required documentation in Ontario. In reviewing, don't think of just your schedule that you need to cover this. What's important, yes, you try your best to cover, but at the end of the day, you have to understand your content, not just for the sake of finishing, but really substance over form, quality over quantity, less is more. Let's go by this principle in studying, okay? So as much as possible, put all your cell phone far away from you, which sometimes we cannot do, but as much as possible, if that's your weakness, then do it. Help me, God, to overcome temptation of social media. Go. Required documentation in Ontario. If you are filing a claim with an insurer like Sun Life, Manulife, Canada Life, you will typically need claimant statement, the formal application for the benefit. Of course, forms is very important. Physician statement, a detailed medical report from doctor who treated the injury or pronouncing the death. Okay. Next, official report. This includes police report, especially for car accident, and the coroner's report or toxicology report to rule out exclusion like intoxication or suicide. Okay, so how to contest a denial? If an insurer denies an AD&D claim in Ontario, often by arguing the death was natural rather than accidental, you have specific path for recourse. What are these paths? Internal appeal. Most insurers have an internal ombudsman, or you can contact the ombudsman service for life and health insurance for a free independent review. FSRA for complaints regarding the conduct of the insurer or agent. You can file through the Financial Services Regulatory Authority of Ontario. So what would be most helpful next? Do you want to see a list of common ADD exclusion like high-risk hobbies and intoxication? Are you looking for limited period, especially for contesting a denied claim? And explain the difference between accidental death and life insurance. Why not? So this we are still number 4. It's okay. As I said, let's learn. We are learning, right? Yes, to keep your momentum going, here's a breakdown of common exclusion and legal timelines you need to know for AD&D claims in Ontario. Common exclusion, even if a death is accidental, insurers in Ontario will often invoke specific exclusion to deny a claim. Common ones include intoxication if the insured's blood alcohol level was over the legal limit or in non-prescribed drugs were in their system, the claim is almost always denied. High-risk activities, death resulting from hazardous hobbies like skydiving, motor racing, and hang gliding are typically excluded unless a specific rider was purchased. High-risk activities. Criminal act if the accident occurred while the insured was committing a criminal offense, self-inflicted injury, an attempt at self-harm regardless of mental health status at that time. So limitation period of denial. So clear, okay. So please do not do this if you want to claim your accidental additional benefit from your life insurance, intoxication, life risk activity, criminal, and self-inflicted injury. Because these are excluded, you cannot receive your accident, death, and dismemberment insurance benefits. The limitation period for denied claims in Ontario, insurer denies your ADD claim 2-year clock. Under Ontario Limitation Act, you generally only have 2 years from the date of the denial letter to file a lawsuit. Internal appeal warning: do not be misled by the insurer's internal review process. As mentioned earlier, the clock does not stop while they reevaluate your claim. If you wait 24 months for an internal answer, you may lose your right to sue. Accident, death, and dismemberment versus standard life insurance. It is important to distinguish between these two, as they often pay out different amounts. Standard life insurance pay out almost any cause of death except suicide within the first 2 years. ADD only pays if the cause is strictly accidental. Double indemnity. Some policy features double indemnity, meaning if you have a 100K life policy and died in an accident, the beneficiary gets the 100K life benefit plus the 100K ADD benefit for the total of 200K. What should we go from here? Do you need help understanding beneficiary revocation only? So that's it. So here, what is needed to substantiate the accident, death, and dismemberment claim? Detailed medical evidence. Okay. Who is not classified as a claimant? Insured estate, primary beneficiary, insurer. Yes. Claimant may be the insured estate, or one or more designated beneficiary, either a primary or contingent beneficiary, an assignee of the insurance policy, or the death benefit may also make a claim to the insurer, but not the insurer himself who will file a claim, not classified, okay? Number 6, when a life insurance policy mature, when the life insured dies, who must satisfy certain requirement to pay the benefit? Who must satisfy certain requirement to pay the benefit? Claimant. When a life insurance policy mature, when the life insured dies, claimant must satisfy certain requirement for the insurer to pay the benefit. Of course, self-explanatory. Number 7, what happened to the pension if the life insured dies after retirement? What happens to the pension if the life insured dies after retirement and their spouse is eligible? The spouse may be entitled to a survivor death benefit. So if the pensioner had an eligible spouse, the spouse may be entitled to a survivor death benefit, usually a reduced amount of the pension that was paid to the pensioner. If there is no eligible spouse, a commuted lump sum representing the remaining payments in any applicable guarantee period will be payable to the named beneficiary. If there is no named beneficiary, it would be paid to the estate of the pensioner. Okay? Death after retirement. What is not caused by an accident or illness causing disability? Inability to continue work, depression, anxiety, these are causes of accident and illness causing disability. But unable to find a job is not a disability. So let us pray. What is not caused by an accident or illness causing disability? Being unable, yeah. So why unable? Yes, correct. Because economic versus medical, this is an economic or labor market issue, not a medical one. So disability insurance is designed to replace income loss due to a physical and mental inability to perform work duties. Unemployment, if you are healthy and capable of working but cannot find a position, this falls under employment insurance, not disability coverage. Why the others are related to disability? Inability to work, this is the direct result of a disabling accident or illness and is the primary trigger for a disability claim. Depression, anxiety, mental health illness in Ontario, most modern disability policy recognize mental health condition as valid illnesses that can cause a total or partial disability, provided there is a detailed medical evidence from a specialist. If you are looking into how disability is defined in Ontario, I can explain. Actually, these are topic not just in ethics. This is also like in life insurance exam modules. So knowing about own occupation means that you cannot even you go back to your other work that is not your main expertise, you can still be paid with that disability. Any occupation, so you want to review with that because this is also good. So to help you master the nuances of disability insurance in Ontario, here's the breakdown of the key definition and timeline that determines whether the claim gets paid. Okay, so if own occupation and any occupation, most critical distinction in a disability contract. So just refresher and review. I know I tackled this in my other content. So you are considered disabled if you cannot perform specific duties of the job you had at the time of the injury or illness. This is common for high-earning individuals like surgeons who can no longer perform surgery but could still teach. Any occupation, this is stricter in definition. So on occupation, you pay higher premium for that because once you get sick and then, and no longer can perform your specific expertise, you can still be paid with disability insurance. But for any occupation, stricter definition, you can only consider disabled if you cannot perform the duties of any job for which you are reasonably suited by education, training, and experience. So the transition, many group policy in Ontario use own occupation for the first 2 months and switch to any occupation for the remainder of the claim. So elimination period, waiting period, disability benefit do not start the day you get sick. So there is what you call deductible of time. You must be disabled for a specific number of days before payments begin. Common length, typically 30, 60, 90 days. No longer elimination period usually starts in a lower premium. So a longer elimination period usually results to lower premium. So short-term versus long-term. Short-term disability often has 0 to 7 day wait. while long-term disability usually kicks in after 119 days, aligning with the end of employment insurance sickness benefit. So, are you with me? Yes, we are learning here, right? Even it's a review. Yeah. Government supports in Ontario. If you do not have private insurance, Ontario offers two main safety net: EI sickness benefit federal program providing up to 26 weeks. So if there are 4 weeks in every month, 4 to 5 weeks, C go Lita, C lack C. So around 6 months of paid leave if you cannot work for medical reason. ODSP program, a provincial social assistance program for residents with a substantial permanent verified disability. It is means tested, meaning your asset and income affect your eligibility. Next step of your research. Presumptive. So that's more on disability insurance. Let's go back to our topic. So what is not caused by an accident or illness causing disability, unable to find work? Okay. What happened to the pension if the life insured dies before retirement and the spouse is eligible? I think we did it, no? The spouse may be able to roll it into his own locked-in plan. So when a person receives a pension under a pension plan, and his or her spouse is also eligible under the same plan, if the person dies and the benefit will become payable to the spouse, even if the spouse was not the designated beneficiary, the spouse may be able to roll it into his own locked-in plan. If there are no eligible spouse, the pension benefit will become payable to the named beneficiary. If there is no named beneficiary, the pension amount will be payable to the estate of the pensioner. What is established when applying for insurance and premium? What is established when applying for insurance and premium are usually adjusted based on this. Proof of age is usually established when applying for insurance and premium are usually adjusted based on the true age of the life insured. So you need to provide proof of your age, identity, birth certificate, or valid ID. What does the insurer receive when insured person dies? Notice of death. Notice of death. Okay, when the insured person dies, the insurer usually receives notice of death from the agent, the estate executor or trustee, a beneficiary, or from agent, from estate executor or trustee, or from a beneficiary or the employer. Notice of claim. Who received the remaining payments, or in some cases may agree with the insurer to terminate the contract early if the life insured dies before the insurer has made a stipulated number of payments. Who received the remaining payments, or in some cases may agree with the insurer to terminate the contract early if the life insured dies before the insurer has made a stipulated number of payments. Annuity guarantee. This means that the person whose life is insured dies. This means that if the person whose life is insured dies before the insurer has made a stipulated number of payments, the insurer remains obligated to continue payments. This is the guarantee. The annuity guarantee if not the same person as the annuitant, may receive the remaining payments. Or in some cases, they may agree what the insurer to terminate they may agree with the insurer to terminate the contract early and accept the committed amount in the settlement of the policy, segregated funds and annuity. So even you are talking about ethics, you talk across all other topics. Disability insurance, now segregated funds and annuity, because it's talking about claims and payment options for chapter 2. Which type of insurance provide lump sum payment should the insured become seriously ill? Critical insurance or critical illness insurance provides a lump sum payment should the insured become seriously ill. Disability insurance is not. So let's dive in more. Okay, I think we still have more time. You just pause if you feel like you need to go to toilet or you have something to do. And please do like and subscribe and share this if you have been benefited with this review that I am doing. Yes, let's work together hand in hand. I'm building team here in Ontario. Please join my team if you like us to encourage one another and help as many people, and we go succeed together and help and bless the advocacy that we are in. If you want to know me more, I really have a special child, so my heart goes to helping special children advocacy and helping schools that support children with disability or some special needs, and also most importantly Christian education, churches across different nations, especially in the unreached people group, how we can send more missionaries to help our unreached people group so that Jesus will come again soon when most of the people have heard the good news. Anyway, just a sidetrack, but now let's move on to our dive in about the different terminology, yes, of segregated funds and other insurances. So which type of insurance provide lump sum payment should the insured become seriously ill? Usually it's the critical illness insurance because you need the money for your treatment. So critical illness insurance provide lump sum payment should the insured become seriously ill. Why critical insurance is the correct choice? The trigger, it pays out one time, tax-free lump sum if you are diagnosed with specific life-altering condition covered by the policy such as cancer, heart attack, or stroke, and survive the survival period of 30 days. See, very nice as we dig in deeper because this will give us important information that you should survive within the 30 years to be able to get your lump sum payment of your benefit. The use of fund, unlike disability insurance, there is no restriction on how you spend the money. You can use it for medical treatment, home renovation, or even pay off a mortgage once you get your lump sum. No? Why the others are incorrect. The example, disability insurance, this provides monthly income replacement if you are unable to work. It is almost never a lump sum payment. It's more on a monthly. Increasing illness insurance, this is not a standard type of insurance coverage. The accidental dismemberment, it pays out only for physical injury, loss of limb sight caused by an accident, not for illnesses like cancer, organ failure. So if you're comparing policies in Ontario, detail the big three illnesses covered by almost every critical illness. Explain return of premium rider that gives your money back if you stay healthy. help you find Tanisha. Okay, please. Anyway, let's move on. So clear? Yes, number 14. Which one is not part of the sequence to assess disability claim? A physical assessment the insured must perform for the life insured family friends. You don't need that. You only need a period of what? Total disability may be required before partial disability benefit are available. So waiting period must elapse before benefit are payable. Periodic assessment of whether the claimant is still disabled. These are important to assess disability claim. What is not part is that physical assessment of the injured must perform for the family, for the life of the insured family and health. No need. Okay? So the sequence is as follow. Please be very sure of this. Be mindful of this. The sequence. First, a period of total disability must be required before a partial disability can be given or available. Then, in this situation, the waiting period must elapse before the benefits are payable. Proof of insured person is no longer able to perform the duties and activities of the occupation is required. Periodic assessment of whether the claimant is still disabled. Periodic assessment of whether the claimant is still disabled. Assessment that a claimant has recovered or not. Not his family members have. Okay, very good. So if you like that, you can have like Word file at the side where you can copy paste what you want to review in the last minute before you take your exam. So like sequence, ethics. About ethics, there's a sequence to what is it? Ganyan? Oh, forgive me with that. This is the sequence to assess a disability claim. Okay, next. Let's move on. Is this the one, right? Chapter 2 quiz. Yes, that's it. Number 15. How long does the life insured go missing before interested party asks a court to declare from death? 7 years. If they have disappeared and remain missing for 7 years or more, interested parties, most often the family can ask the court to declare them dead, and upon an application filed by an interested person, a court may make an order declaring that such person has died. But if like it's a plane crash, you don't need that long. Yeah, maybe 2 years. Let's see. What is it called? Okay, maybe you want more explanation on this? Yes, we can also. Because there's an exception to the 7-year rule. If other accident do happen and the remains is not found. So yeah, it could be. Ontario Declaration of Death Act 2002. Under common law, a court may declare an individual dead if they had been missing and have not been heard from for a period of 7 years. For the court to grant this declaration, the interested party must typically prove there is no evidence the person is still alive, reasonable effort have been made to locate them, there is no alternative explanation for their disappearance, such as fleeing legal trouble. Why other options are incorrect? Yeah. So 6 months is far too short for a legal presumption of death. True insurers may investigate claims of accidental death in short window if there is physical evidence like shipwreck or plane crash. 30 days is often the survival period required for a critical illness claim to be paid, but it is not used for missing person cases. 3 months is common waiting elimination period for disability insurance until it has no legal standing for declaring a missing person disease. Okay? So earlier declaration, if there is strong circumstances evidence that a person died in a specific event, like as I said, plane crash, where no body was recovered, the court can declare the person dead well before the 7-year mark. Would you like to know the specific application process for the declaration of death in Ontario, or how insurance premium are handled while the person is missing? Yes, right? We want to know that so we can advise our client someday. In Ontario, handling missing persons' life insurance is a delicate legal process regulated by the Declaration of Death Act 2002 and an Insurance Act. The court application process, if there is no body but the 7-year mark has passed, there is clear evidence of a fatal event, interested party must apply to the Superior Court of Justice. The evidence you must provide affidavit detailing the disappearance, police report, and proof of thorough search. The order, if satisfied, the judge issue declaration of death, which serves as the legal equivalent of a death certificate for the insurer. What happened to premiums? This is a major pain point for families. Technically, the policy must remain in force to the payable. Keep paying to ensure the benefit is paid once the declaration is made. Beneficiary usually must continue paying premium during the 7-year waiting period. The refund, if the court eventually declares that the person died on a specific date in the past, the day they disappear, the insurer must refund all premium paid after the date plus interest. See, so this is a wonderful information for us to advise our client, right? Keep paying premium. Even the insured person was missing and you're not sure if they are truly dead or not. Because it will just be refunded. The risk, if you stop paying and the policy lapses, the insurer may deny the claim entirely, even if the person is later on declared dead. In earlier declaration, you don't always have to wait 7 years. A court can declare someone dead immediately if they were involved in a perilous event. Example, if the insured was a passenger on a plane that crashed in Lake Ontario and no body was recovered, the court can bypass the 7-year rule and declare them dead based on the probability of death at that specific time. Next step for your research. If you are managing a difficult claim or studying for HLLQP, Harmonized Life Insurance Qualification Program, learn about the public guardian and trustee rule in maintaining a missing person property. Yes, so since we are studying for that, let's go and dive in more. Okay, so yes, sometimes this is a shortcut way of reading the whole ebook or textbook. Okay, to wrap up your look at Ontario's law regarding missing person and insurance, here's the final breakdown of the public guardian rule and the difference between presumption versus declaration. Managing the missing person asset. If a person disappears in Ontario, their property, like bank accounts, house, doesn't just sit in limbo for 7 years. The public guardians and trustee Under the Absentee Act, a court can appoint a committee, often a family member or a public guardian and trustee, to manage the missing person's affairs, paying premiums. This committee has the legal authority to use the missing person's own money to continue paying life insurance premium, ensuring the policy doesn't lapse before the 7-year mark. That's managing. Presumption versus declaration. These terms often confuse but have different legal weights. Presumption of death, this is a legal in reference. Presumption of death, this is a legal in reference drawn from the fact that someone has been gone for 7 years. It allows court to begin the process of settling an estate. Presumption of death. Declaration of death. This is a formal court order issued under the Declaration of Death Act 2002. This order is the golden ticket. Insurer must accept it as a proof of death to pay out the claim. What if the person returns? It sounds like a movie plot, but it happens. If an insurer pays out a death benefit and the person later returned up alive, the insurer's recourse is that the insurance company can sue to recover the funds paid to the beneficiary. The beneficiary protection, if the money has already been spent in good faith, courts sometimes limit how much the insurer can claw back, though this varies by cases. This, that's nice study. Next step for your goal. If you are preparing for HLLQP exam or managing a real-life situation, review the statutory condition in Ontario Insurance Act regarding proof of loss. Yes, okay. Proof of loss. It sounds like you're on the roll with this insurance law and LLQP style questions since we've covered annuity, limitation period, AD&D, and missing person. Here's a few other high yield topics often tested or questions in Ontario. The incontestability rule. Once life insurance has been in effect for 2 years, the insurer cannot contest the claim based on a misstatement by the insured unless it was fraud. The trap. If the insured lied about their age, gender, and insurer won't cancel the policy, but they will adjust the death benefit to what the premium should have bought for the correct age. Preferred benefit under older Ontario law, pre-1962, under older Ontario law, pre-1962, certain family members have special protection. Today, the big distinction is revocable or irrevocable. Irrevocable, you cannot change the beneficiary or withdraw cash value from the policy without the person's written consent. This is a powerful tool for creditor protection in Ontario. The suicide clause. Almost every policy in Ontario has a 2-year suicide exclusion. If the insured died by suicide within 2 years of the policy start date, the insurer only refund the premium paid. After 2 years, the full death benefit is usually paid out to the beneficiary. How would you like to proceed? That's it. I'm done. Extension, because, okay, next. For 7 years, right? What is it called when policies only pay when death is associated with an accident? If it's an accidental death policy, other policy may only pay the death is associated with an accident. These are called accident death policy. The insurer will need to receive proof of death was associated with an accident and not excluded under the exclusion in this policy. accident death policy. There's no such thing as presumption of death policy, accidental disappearance policy, intentional disappearance policy. No, only accident death policies. Okay, 3 more to go. 17. What does insurer base paying the benefit on the most recent designation on file? Who or what do insurer base paying their benefit on the most recent designation on file? Beneficiary. Insurer will pay benefit based on the most recent beneficiary designation they have on file, or to the estate if there is no beneficiary. Clear. Under provincial and territorial insurance laws, within what time frame is an insurer obligated to pay a claim upon receiving satisfactory evidence? 30 days. The insurer is obligated by provincial territorial insurance law to pay a claim within 30 days of receiving evidence that satisfies what the claim is payable. Time to pay claim. Yes. What do insurer not require in all cases? Probate. They will require proof of age, death certificate, proof of identity. So insurer does not require probate in all cases. They must receive sufficient evidence of the party's right to receive payments. Okay? You want to know what probate is? Then we need to dive in more explanation. But yeah, we can move forward to number 20. I'm excited to move forward to number 20 actually. Yes. So number 20, who must complete a claim form? Beneficiary. A beneficiary must complete a claim form. Agent can obtain the claim form from the insurer. A beneficiary, the estate executor, or the estate trustee may also obtain the form directly from the insurer. So based on the choices, not funeral director, not agent, of course, not the insurer themselves, because they're the one who will give out the benefits, like the beneficiary. But others can also file, right? As it is said here, estate executor, estate trustee can also file. While the agent is the one that obtains the form from the insurer to give to those beneficiary who will make a claim. So why it's not, name beneficiary if a life insurance policy or annuity has a named beneficiary other than the estate, the proceeds pass directly to that person. This is known as bypassing the estate, and the insurer typically only needs a death certificate and a claim form. No probate is necessary. Small estate. Even if the estate is the beneficiary, after this, even if the estate is the beneficiary, some insurer may waive the probate requirement for very small amount. Even if the estate is the beneficiary, some insurer may waive the probate requirement for a very small amount if the heirs can sign an indemnity agreement. Why the others are mandatory? Yes, of course, that certificate, legal proof that the insured event occurred. No insurer will pay a death benefit without it. Proof of age, because premiums are based on life expectancy, insurer must verify the deceased age to ensure the correct benefit is paid. Proof of identity, anti-money laundering, know your client regulation in Canada required insurers to verify the identity of the person claiming the funds. Yes, who is managing estate? I think we're done, right? Yes, we're done. Who files the claim? Yeah. So to help you master, let's continue. Probate and estate side of Ontario Insurance. Here is the breakdown of how to avoid fees and what the current 2026 rule look like. how to avoid probate fees, estate administration tax, how to avoid probate fees. In Ontario, if a life insurance policy or a segregated funds as a named beneficiary, a person, or not the estate, the money is paid directly to them. This is to avoid probate fees. The benefit, this fund bypass estate entirely. They are not subject to 1.5 tax, 1.5% estate administration tax, EAT, bucket EHT, and are generally protected from the deceased creditors. The risk, if you name estate as beneficiary, the insurance money becomes part of the probate process, meaning the government takes its cut and the money can be used to pay off the deceased debt. Ontario probate fee structure. Ontario has one of the simplest but most expensive probate fee structures in Canada as during T26. The first 50,000 no tax is paid on the first 50,000 of estate value. The amount 50,000, like $15 for every 1,000. Oh, so if 50 times 15, right? Let's see, it's $15 per 1,000. So you have to pay 5,250 before your 50,000 if ever you're above it. So example, on an 500 estate, the probate would be taxed to be by naming beneficiary on a 500 life policy. Instead, you save the entire amount Ontario Ministry of Finance. So estate administration tax. So the declaration of entitlement, if a person dies intestate without a will and there is no named beneficiary, the insurer cannot simply hand over the money to the closest relatives. A family member must apply to the court for the certificate of appointment of estate trustee without a will. In some cases, for a small amount, the insurer may accept a declaration of entitlement and an indemnity bond, which saves the family from full court application. Okay, that's it. So thank you very much. That ends our chapter 3 quiz review for ethics regarding the claims and benefit option or benefit payments options. So thank you and see you in chapter 4. We study each topic before we go to the quiz. God bless you.